Hello, everybody. And today is a special day because we have had earnings from the cheapest stock in my entire universe, StoneCo, a stock that is even cheaper than HIMSS. It's to tell you how cheap that stock is. And that stock gave very good earnings and a very, very good full year 2022. In fact, it did exactly what Wall Street wants, which is net income, cash, and reduced marketing expenses. And the stock is only up like 3%, which, as I thought would happen, Wall Street doesn't care. So StoneCo goes out of its way to give Wall Street exactly what it wants, and Wall Street doesn't care by giving it just 3%. So for this stock to go up, I believe we need a risk-on environment, which we're probably about to get now that the Fed kind of broke a part of the regional banking system in the US. But really quickly, let me first focus on their revenue growth. So revenue growth is what's most important to me. The reason for that is, I try to get into stocks that are going to see tremendous product adoption, and I try to get in early. So StoneCo, what do? Right? They're payment terminals for small business. They are the Square of Latin America. Essentially, it's that tiny payment terminal that you see all over the US. They sell those same terminals in Brazil, and they also have a small software business. And so the whole idea is that I believe that these terminal payments are going to revolutionize what banks have historically done, which are these bulky internet-connected payment processor. I believe that's going to be disrupted, and so you invest in companies like that. And so when I invest in a product that I believe will be disrupted, it typically follows an adoption curve, and revenues are a wonderful proxy for that adoption curve. And the whole point of my type of investing, which is hyper growth investing, is I want to get early before I get all of that revenue growth, and I want to stay in the stock, say 5 to 10 years. And as soon as growth really starts to stall, right, as soon as we get a stock that starts growing at the same rate as the economy, that's really when you want to get out, because then the stock will be trading based on earnings and not trading based on growth anymore. For StoneCo, you have outstanding growth, and you have a stock that is trading as if it had no growth, and a cheap stock at that had no growth. So that's why I actually love StoneCo. So let's go over their growth. So keep in mind, they report everything in reals as far as their investor communications, right? Not their GAAP, but everything that's investor communication is in reals. So keep in mind, all of those numbers you see are in reals, and 1 real is about 19 cents. So let's look at, it's a Brazilian stock, right? So let's look at their growth, and I see a little lumpiness, like in Q1, between Q1 and Q2, they saw some growth, even though they were at the depth of the beginning of that 2022 crisis in Brazil as well. But it's been decelerating a little bit, but we'll see why. That's because marketing expense is way down. That's the reason why they've had some decelerating growth. So they're kind of having their trajectory. But if you look at the quarter-over-quarter growth, first of all, I love the transparency of StoneCo. Thank you for not having me go dig into the past annual reports, because you don't want to show a deceleration, right? Quarterly reports, I meant. Some stocks don't want to show a deceleration of the business, so they'll just report yearly, and they won't report every single quarter. StoneCo reports every single quarter. I love the transparency, and we can see a slight deceleration between Q4 to Q3 and Q3 to Q2. We're at 7.9% quarter over quarter versus 8.8% of the quarter prior, 11.4% and 10.5%. When I see this slight deceleration, knowing that they've literally, you'll see they've greatly stopped their marketing spend. Knowing that doesn't concern me at all. And the guidance that they gave, by the way, is absolutely laughable. It's like they probably included it to fill a slide. I would love to be in the management's mind on this, because their stock has received no credit for the past almost a year and a half. And so they just put a guidance that's entirely safe for them. So maybe thanks to that guidance in Q1, they can show a tremendous beat. So I'm just going to assume, because this business has had a very consistent tiny deceleration in the business, I'm just going to also assume a deterioration of the growth rate by 8% each quarter. So when I do that, that means for Q1, right, for the next 3 months, I'm assuming a 7.2% growth, 6.7, 6.15, and then 5.66 for each quarter. So you extrapolate, right? You go from the 2.7 billion reals, and you increase it by 7%, then 6%, then 6%, then 5%. So you extrapolate each quarter billions in real, right? Each amount in real, and then you add it up. And when I add it up, my sandbagged estimate is 12.7 billion reals that they will do over the next 12 months, over the next 4 quarters. Prior revenue over the past 4 quarters, right? The past year was 9.6 reals. So I am forecasting a 33% forward growth, assuming consistent deceleration across the 4th quarter. But we know, when we look at the past quarter, we've had a surprise up quarter in Q2 of 2022. So I do not know the cyclicality of the businesses, but it's entirely possible that we get an up quarter in Q2 of 2023, right? So I believe my numbers to be very conservative and very sandbagged here. I believe they will beat it handsomely. But it's better to be conservative. And so we have 33% growth when I'm conservative, which is well above my 30% threshold that I look at on my stocks. And by the way, if StoneCo had only, if I was only calculating, say, 5% for StoneCo, that would be okay, because the valuation of this stock is so dirt cheap. I mean, it's not even funny. Like I don't understand what Wall Street is doing. This stock has been forgotten. So, the reason why it's low, right? The reason why my forecasting is low, I believe, is because of Wall Street. It's all about Wall Street's fault. So when I look at their income statement, right, look at this. It's like, so they've had year-over-year growth of revenue of 44%, but the growth in their selling expenses is only 27%. What that means is that even though they're growing revenue, they're not spending a fixed amount of that revenue on marketing. They're decelerating greatly their marketing spend as a share of revenue, even though we are increasing marketing slightly from a nominal standpoint, right? From the amount that they're investing each quarter, it slightly increases, but actually, compared to the revenue increase, they're decelerating. Like, this is a major deceleration in their marketing spend. And why is that? That's because Wall Street right now is so short-sighted. They want profits now, and so they are discouraging actively marketing spend. I remember the last conference call that I listened to StoneCo. It's all about asking for earnings. We want cash now. Like, analysts put pressure on CEOs and investor relations to focus on these earnings, which, as a growth investor, I'm sad. I'm sad as a growth investor, because that's a financial strategy. And I want them to grow market share. I want them to be the uncontested monopoly of payments in Brazil. How do we think that Square became essentially close to a monopoly in the US for payments, right? At small businesses. Why are they essentially almost a monopoly for payments at small businesses right now for Square? Because they invested heavily in their market share. Let me ask you this question. Do you think Amazon, or do you think Netflix would be so big today if these companies had focused on profits and growing the cash pile early in their career as a company? No, it's all about terminal value. Like, you have to be able to look at. So I'm not too upset, because the company is still growing revenues at my prediction of a 33% next year, sandbag prediction. It's still a very fast clip by all standards in this environment, so I'm not upset. But I believe that if they were spending I'm not even talking about an increase in selling expenses, but if they were just spending on marketing consistently what they've spent in the past as a share of revenue, I believe this number would be in the 50% range. I mean, because for a company like this, marketing is an investment. Once you get that terminal set up in a small business, once you invest in education, salesperson goes to a small business, demonstrates the product, and then the small business buys the product. Once you've invested into that marketing, the small business that has the terminal, they're going to use that terminal for 10 plus years. Right, so investing in marketing makes sense for me for StoneCo, and just the idea that they're trying to show these profits early on, I think is misguided, and I'm hopeful that the market will go back to growth, will go back to risk, because that is the nature of technology. That is how technology wins. Most markets in tech are winner take most market, and so for that you need to put strategic priorities, i.e. your market share, ahead of financial priorities, as long as you have positive cash flow, which is not a problem at all for StoneCo. They have positive cash flow. Let me actually show, speaking of cash, right? Let me show you that cash pile that they have. So they have 670 million USD or 3.5 billion reals on their balance sheet. For a company, keep in mind, that has a market cap of 2.84 billion USD. Like, what business does this company have having 24% of its market cap in cash? That is crazy high. That is very, very, very high. This is a company that is well into the anti-fragility bucket when you have so much cash on your balance sheet. And they've been focusing on increasing that cash pile. And I'm hoping as soon as we get back into an economic recovery, we get out of this recession, I'm hoping they draw on that cash pile in order to invest in marketing, invest in gaining market share, invest in promoting the software business that they've just acquired. Again, and think about that. This is a company that's $2.8 billion of market cap, right? And actually, if you bought it like 10 days ago, it was even cheaper than that when it was like in the low $8 a share. Anyways, and they had my sandbag guidance for next year, right, is 12.76 billion reals or 2.36 billion USD. So the stock right now is trading at 1.2x next year's sell. That is dirt cheap for a business that has a 74% gross margin. That is dirt cheap. I don't know what to say. I love Brazil. Forget about Chinese stocks. You hear a lot of people on Twitter tell you Chinese stocks are so cheap. Forget about the Chinese stocks. The Brazilian stocks are the real deal. They are so cheap. Whether I look at StoneCo or Mercado Libre or Nubank Holdings, I mean, these stocks are so cheap. I don't know why the market is sleeping on Latin America. They're really, really sleeping on Latin America. When I see those numbers, I see opportunity. And how's the business going, right? So actually, it's very interesting because we can clearly see the stop of marketing spend. So we can see that their financial services, right, the digital banking, the payment solution, these terminals, these Latin American version of these Square terminals in Brazil, we can see that they kept growing at a very high clip. 49% year over year, so much so that it's now 85% of the business. Actually, beginning of 2022, it was more like 75-25. Now it's 85% of the business. The software is, quote unquote, only growing at 21% year over year. And that's a business that they acquired, right? They acquired that ERP, that kind of the QuickBooks Intuit for small business, as I call it. They acquired that. And I will ask Wall Street, can we please invest a little bit in sales and marketing to grow share? Like, this is software. Once your enterprise resource planning system is installed, right, within a company, it's here to stay. It's here to stay for a decade plus. Once a small business has an ERP system, they're not changing it, right? Look at companies like Oracle. You think a lot of people are moving away from Oracle or QuickBooks? No. So it makes sense to invest in marketing. So can we please invest in marketing to grow the software business? And no, we can't, because Wall Street said no. Wall Street said we need to have a cash pile, even though we get no credit for it in the stock price right now. I think there's no credit for it in the stock price. And I guess that's better for us, because that's better for me, because I get to buy the stock for cheap. But marketing is an investment for a business like StoneCo. You're not trying you're not trying to sell a car. You're not trying to sell a product that you're just going to sell once, right? You're trying to sell a product that is going to be recurring revenue for multiple years to come. Let me move on. Another evidence that this is a company that's trying to make money. This is a company that is trying to make money. Look at this gross margins. I went back and calculated the gross margins for past 4 quarters. They've increased gross margin from 66% in the last quarter of 2021, and now they're at 74%. 74%. So this is a business that's flexing its muscle. This is a business that's trying to prove a point to Wall Street that it can make money. And furthermore, they have marketing down. They spend less on marketing relative to revenue. They have administration spend down, right? So it's like they're trying to show revenue, and they're trying to do this with a keyword in their report was efficiently. You're trying to show profitability as much without hurting revenue growth. That is just the state of the market today. That is okay, but this company, I believe, is not getting any credit from Wall Street for doing that. So that's why if you're not going to get any credit from Wall Street, if you're going to be abandoned by Wall Street, I'd rather see them invest in marketing and focus on market share and grabbing that market share, being that winner-take-most player. So let me extrapolate, just to finish on this, let me extrapolate income, because that's Wall Street speak, right? Wall Street right now loves income. So let me extrapolate. And income, by the way, is going to grow much faster than earnings growth, but I kind of don't want to calculate earnings, because earnings is not my style of investing. So I'm just reusing my revenue growth numbers as a proxy for earnings, keeping in mind that the earnings are going to grow faster than revenue with how many cuts we are doing on marketing spend and administrative, etc. So assuming the same rate of growth for each quarter, we'd get so last quarter, Q4 2022, we had 234 million reals of net income, right? So Q1 23 would get 252, Q2 23 269, and so on for Q3 and Q4, right? Multiplied by our growth rate. That means that for the next 4 quarters, for the full year of 2023, you're going to have 1.1 billion reals, or 210 million USD of net income. If I divide the current market cap by next year, this is next year's net income, I am getting a 13x PE. By the way, the dilution, if you saw on the other slide, if you go look at the report, the dilution is not that bad. So almost no dilution. But anyways, and that's for a business. Keep in mind that 13 times PE is for a business whose revenue will be 33% higher next year. So the S&P 500 right now is more expensive and has nearly no revenue growth. Right? They'll grow at the rate of the economy, and the rate of the economy right now is a recession. So that's no revenue growth, right? M2 is going away. There's less M2 circulating. Anyways, so earnings growth will certainly outpace revenue growth because of all of the cost cutting that I really don't like to see. But assuming 34% earnings growth, you get a company that has a 2023, so I'm doing kind of a double forward growth ratio, a 2023 PEG of 0.39. And assuming 50%, which I think will be closer of their net income growth, 50% earnings growth here, assuming that you get a price earnings to growth ratio of 0.26 for 2023. I'm doing a base 2023, not a base 2022 here. So again, Peter Lynch ratio. Peter Lynch says on his ratio, under 1 is good. I mean, you're getting 3x cheaper of what Peter Lynch would consider good. And by the way, did I mention their cash pile? Which is like if the market doesn't start giving credit to StoneCo for its cash pile, we need to get ready for a stock that's going to trade at 50 or 60% market cap of cash at the speed at which they're growing cash. I mean, they're going to double cash again. So is this stock going to be trading at 50 or 60% of cash? You know what I mean? Like it's crazy. It's crazy. So anyways, I'll conclude with this, and there's a little bit of macro, and I think it matters. So you can see the USD versus the Brazilian real has been pretty stable. I would argue that the monetary policy of both countries has been equally loose at equal times and equally tight at equal times. So that's why it's been 19 cents for a long time. But with what happened to the U.S. banking system yesterday and 2 days ago and on Friday, I think there's a strong case I'm making that we're going to get a Fed pivot, which means that if you get a Fed pivot, the value of the dollar may go down. And so if the value of the dollar go down, but let's say Brazil still remains restrictive, I know they're fighting inflation over there, just like in the US, then you may get a situation where the Brazilian real goes up in value compared to the US dollar, which would make those results in USD look even better. So in conclusion, I am so happy with StoneCo. The stock is only up 3%, which means that I can keep buying, and I'm sure I'll keep buying it for the next year because the market is ignoring this stock. This market is undervalued, and one day this stock will be discovered. And when the stock is discovered, when people value that stock at its real value, it's when I'll have to stop buying because I believe this is a stock that has a lot of upside. So, but that's not investment advice, right? Just entertainment, no investment advice ever. I am off to listening to the conference call of StoneCo. I appreciate your likes and your subscribes and your comments. Thank you, and have a wonderful day.